Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. As I hope many of you realize that this is a series of articles where I'm going through all the various sectors that are produced by FactSet, the data provider behind FastGraphs. And what I do is I go to our screening tool here. I use our screening tool and I go into all these various sectors here that you have. And the sector I'm looking at today is energy minerals. So when I first run the screen on energy minerals, the first thing I want you to notice is there are 619 companies out of over 19,000 to choose from. Then I go and apply several other screens, like I do credit ratings and PE ratios and debt levels. And by doing that, I came up with 16 companies in this sector, this primary sector, that I thought were worthy of showing you. And when I organize them by subsector, I want you to notice that there are 8 oil refining companies, 7 integrated oil companies, and 2 companies that are in the oil and gas production sector. So these are the 16 companies that I'm going to cover. Now what I've done is, don't really think it's appropriate to go through all these companies in a video like this. I've picked representative stocks. I've picked 2 companies from the integrated oil sector. That would be Lukoil, which is a Russian oil and gas company. I thought you'd find it interesting to look at that. And then, of course, the 800-pound gorilla in the industry, Exxon, is an integrated AA plus rated company. And then in oil and gas production, I'm going to take a look at Canadian Natural Resources. And then in oil refining and marketing, I'm going to look at Andeavor Logistics and Marathon Petroleum. So let's start by taking a look at the Russian company first, because I think there's some very interesting attributes about these companies. One thing, as I pointed out, written portion, if you look at any of these integrated oil companies like Exxon and look at the price of oil and gas, you'll see a very interesting relationship between the company's earnings and their operating results, especially earnings and cash flows. But what I want you to notice is this particular company trades at a normal PE ratio of 6.4 times operating earnings. That's the blue line on this graph. So you can see the orange line is a PE ratio of 15.4. But I also want you to notice how cyclical this stock is. But if I'm looking for valuation correlations here, it becomes very clear that something around a 6 multiple becomes a reasonable valuation. But even given that, I want you to notice the operating histories of these companies is not very good. The dividend record is a lot better, although in this case it's not even perfect. So let's look at performance of this company from a standpoint of dividends. They cut their dividend in 2014, but otherwise they've averaged just under 11% average dividend growth, and the compound average growth rate of their dividends has been just under 10%. So they've generated substantially more dividend income than the S&P, but they've dramatically underperformed it on a capital appreciation basis. This is something that is relatively normal with these companies. So looking at the Russian oil and gas, integrated oil and gas company first, you see those characteristics. But next I want to take a look at Exxon, which again is the biggest company in the industry and one of the premier oil and gas companies in the world. And when you look at Exxon, here's where you get a real clear picture. It's what I showed in the written portion of this article here. You see that the operating earnings of Exxon correlate very, very closely with the price of oil and gas over time, or the price of crude oil. This is the crude oil price thanks to infomine.com. I want you to notice how you can see the price of oil and gas on a barrel per basis correlated very, very closely with what you see here when you look at the operating results of Exxon. Now, once again, trying to calculate capital appreciation is very, very difficult. If I look at performance, it underperformed the market, Exxon did, but it outperformed it on dividend income, but still was an underperformer totally. That's because these integrated oil and gas companies are very, very difficult. However, their dividend income was rather substantial. Now, my argument is if you're very careful with valuation when you buy these stocks, you can do okay, and not necessarily great, though. These are not capital appreciation companies. Another thing I want to point out is when I'm looking at these stocks, since it's primarily about the dividend rather than the capital appreciation, I tend to focus more on operating cash flow. And what I'm looking for here is to see that operating cash flow covers the dividends. And then I'm also, let me get back to Exxon. I inadvertently brought up the other company here, Andeavor, which I'll get to in a minute. But when I'm looking at Exxon on the standpoint of operating cash flows, the thing that I'm want to make sure of is first of all, that there's more cash flow than dividend income. In other words, they have adequate cash flows to continue to pay the dividend, because the dividend income here is the real allure. The earnings are inconsistent, but the dividend income is very, very consistent. When you look at it from the long-term performance results on Exxon, you can see that they've raised their dividend regularly. It's averaged about 7% dividend growth on average, and the compound average growth rate about the same. But it's been a very steady, consistent income producer. They've generated significantly more dividend income than the market. Their capital appreciation is not bad compared to the market, but it did underperform it. But they came out pretty close to a dead heat. This is long-term performance now, going all the way back to 1998. But the real point is, if you look at what's happened during this period where oil and gas prices were real flat, I want you to notice that the performance here from a capital appreciation point of view was actually very weak. It was actually negative. In other words, $10,000 would have shrunk to $9,800. They still did pay more dividend income than the market, but the reality of it was, because the operating cash flows were not so good, the stock price wasn't so good, but it was enough to support the dividend income, and that's what made this stock actually attractive over time. Now, moving on, if I go on and take a look at the oil and gas production company that I chose here, that would be Canadian Natural Resources. You're going to see another very similar situation here regarding the dividend income versus the capital appreciation or the operating results. Again, capital appreciation is very, very poor. These are very cyclical companies, very volatile companies. The dividend record here is pretty good. Not great, but pretty good. They did cut their dividend in 2015. They haven't even produced as much dividend income as the S&P, nor have they generated as much capital appreciation. But in doing just a little bit of research on this company, what really made this company look interesting was free cash flow. When you look at the opportunity for this company to generate free cash flow going forward, you see these incredible estimates for their free cash flow generation. Now, there are analysts that believe this is going to be true, at least for the next couple of years. So this might really be the allure. The company offers a 3.7% current dividend yield. It's reasonably priced based on most metrics, and it's one that you might want to look at. But once again, these are not great capital appreciation investments. They're primarily all about the income. Now, the next stock I want to look at is in the oil refining and marketing segment. It's Andeavor. And the thing that's interesting about this company, and one reason I chose to share it with you guys today, is the fact that it's definitely the highest yielding company. But there's also a story on valuation. This stock has generally been very highly valued. I'm going to move this back to operating cash flow, because although I used earnings, and I've been using earnings throughout this series, since these are all about the dividend, it comes down to operating cash flow. This is the first time, or really it's been the last year and a half, where this stock has been interesting. I think the stock is extremely undervalued right now, so I do think it represents a really great opportunity. If this were to trade at its normal multiple of operating cash flow of about 10 times cash flow, rates of return for the next couple of years can be extraordinary. So this is one that at least offers some allure relative to the high current dividend yield. Long-term performance has been very, very weak on this company, again, because of the overvaluation that I'm pointing out here. The stock was really highly valued, and consequently the price hasn't performed well. But the dividend income has been extraordinary even when the stock was highly valued. So now that I'm looking at it being undervalued with an 11.5% dividend yield, I think there's some opportunities to make some real decent money on this stock going forward. You could be generating, extraordinary rates of return out for the next 2 or 3 years if you're willing to take the risk of investing in this company. And then last of all, I'm going to take a look at Marathon Petroleum Corporation, another oil refining and marketing company. And I didn't necessarily save this for last, but I kind of like this company for last, because one of the things that's different about Marathon here is that although they still have cyclicality in their operating performance, it's been one of the best performers from a standpoint of growth and from a standpoint of long-term capital appreciation of all the stocks that I've showed you in this sector. It's actually outperformed the market on both dividend income as well as growth. It's averaged 19.8% growth versus 13%. And keep in mind, this period of time on the historical graph here, where we're looking at 2011 forward, has been an extremely good market environment as well. So this stock has outperformed on both dividend income and capital capital appreciation. I find it very interesting in that it trades at around 11 times operating earnings, and that's about where it's trading at right now. In fact, it's 10.2, so it's slightly undervalued relative to the way the market normally has valued the stock. It does offer a good dividend yield. The dividend has increased substantially. However, keep in mind that's kind of a little bit distorted by the very large growth rate it had the first year. So if I trim this down, the company's still been growing their dividend by about 18 to 19% a year going forward. So this is one that I would take a close look at, perhaps. It offers a decent yield. It's got really good valuation, no matter which of these earnings estimates you run, what valuation you want to put on the stock. I think it's got good potential going forward. It might be my favorite in the group. Anyway, this has been Chuck Carnevale. This is my coverage of the energy mineral sector. I hope you enjoyed it. Thanks for watching. Talk to you again soon.